Hi, this is Kerry Artak, excuse me, with Artak Advisory, and this is the AgriTalk video supplement for Monday's show. That is Monday, April 19th. I cover three markets in this segment on today's show, and that is July corn. I should say May transitioning into July corn, July wheat, and August feeder cattle, or I should say May feeder cattle transitioning into August. I'll get to that, why I say that in a moment. But before I do so, I would love to stress the fact that while you're visiting my website, that you fill out my free trial form and take me up on my 2-week free trial offer. I do offer 2 weeks, no questions asked. If you've had a free trial before, as long as it hasn't been in the last 6 months, I'm happy to oblige that. Always looking for new clients, new people to please. And so please take advantage of that free trial offer. I do appreciate it. First name, last name, email address, and preferably a phone number. I will call you during the free trial and talk about your trading and hedging needs. And of course, following up to see if you may be interested in becoming a regular monthly subscriber. So I'm going to jump into today's charts. This is just sort of a big picture reminder of corn. Now, corn is in the presence of transitioning from May into July. It actually has already, well, not quite. The volume is still slightly lower in July. Soybeans and wheat have rolled to July officially. We're a day or two away from rolling. I'm going to change my pointer here so it's more vertical line. Now, what happened last week for the first time is the lead contract, presently May, soon to be July, settled above this 579 even 50% retracement, which is from the 2012 high against the more recent 2020 low about a year ago. And we rallied to within 1% of it in early February when the March contract was front and center. And we had several attempts, most recently over the last month or so. But last week, last Friday, was the first weekly settlement above 579 even by a 1% margin, just barely, I might say, but it was the 1% margin. And so we have an indication of bullish continuation over the next few months to a long-term target that has been in effect since last December. Since we settled above this 465 and a quarter formation, I've been indicating 645 even, or this descending two-thirds speed line, as the ultimate objective. And I've been saying summer, fall, maybe later year, but it looks to me that we could perhaps reach that as early as, say, later June. Or earlier. So I think the conditions are underway now for secondary buying to play out, and that 645 even is likely over the next few months where the broader corn market can place an annual high. And that all remains true above 579 even. Now, on the way down, well, let's talk about the support. Because what if, and let me go back to 579 even, what if we close back below 579 even at the end of this week? And by that point, it will be, by the way, the July contract. And July is priced slightly lower than May. So there is a possibility that that may exist if we do not get the follow through to the upside this week. And if the market backs off into the 570s, there's a very real possibility the July contract may close back below 579 even. And under that scenario, I don't see that as a significant sell signal, but I do think you should allow for 542 and 3/4 then over the following few weeks. 542 and 3/4, this new channel bottom, able to absorb selling really through May and into June, and from here we can turn back up to new highs again. If we close below 542 and 3/4, then 507 and 3/4 is likely within a few weeks. But you know, the truth is 579 even, I'm going to try to approximate it here. That's 579 and a quarter. If we close back below 579 even at the end of this week, you should ultimately allow for the possibility of 507 and 3/4 over the next month or two. It would not be indicated, unfortunately, so it's not as if you would aggressively sell the broader corn market in anticipation of 507 and 3/4. It's just you should know in the back of your head that 507 and 3/4 is in reach. It would be a base of support we'd basically, if we close back below 579 even, be slipping back into this consolidative region again that we spent several months in. And you could say the base for that is 542 and 3/4, but you could also argue that it's 507 and 3/4. So how to play it? I think closing below 579 even, 542 and 3/4 is likely within a few weeks, and 507 and 3/4 is certainly possible within a couple of months. Where I might add, the July contract can bottom out into expiration, and from here the market can turn upward and on to new highs, ultimately anticipating once again this 645 even long-term resistance. But right now I'll leave you in terms of corn. We settled above 579 even, 645 even. Long-term target is now expected in as little as 2 to 3 months. Let's go on to feeder cattle. This is still reflects the May contract. We are rolling to August. August volume is higher. This is just a day or two old. So what happens? I use volume-based rollover in all of my continuation charts, my long-term continuation charts. What you're seeing here is your typical futures continuation chart, the stringing together of previous contracts. So right now it reflects May. In a day or two, August will inherit, if you will, this chart. And August is higher value, about 10 handles higher, if I recall. And so, the August contract will be opening, if you will, right below this 154.37 formation. This is the ceiling, has been my ceiling in feeder cattle all year long, and it is one that can contain annual buying pressures. We did rally to within 1% of it a few weeks ago when May was front and center, and we did so twice, and now we're breaking back. And this has been expected. This is what I've been saying for the feeder cattle market now for the last month or two, that 154.37 is our ceiling, and August will inherit it, and it will be an August ceiling as well that can contain annual buying pressures, and below which the 139.55 area, which is about to be tested actually as far as the May contract is concerned. But this is interesting, and I like that this is happening now, because over the next 24 to 48 hours, the August contract will inherit this. And where is the August contract? Feeder cattle is at 150.95. So when the August contract rolls, it'll be right about where this pencil tip is if it were to do it at this point in time. And so what does that mean? It means that the August contract has been selling off along with the May contract, and there will be that much more to go to the downside. Another 10 handles south for the broader market, and still just merely reapproaching this trend-defining support on the weekly chart at this week at 139.55. So the way I see the feeder cattle market playing out right now, and I'm going to talk August, assuming we will be rolling into the upper 140s, I imagine, over the next few days, that August will inherit 154.37 ceiling, and below which 139.55 is likely over the next, let's just say few weeks perhaps to 2 months at the most. We could trade inside the 139.55 floor to 154.37 ceiling all the way into summer. But if we close below 139.55 at the end of this week in the August contract, and I don't see that happening because, as I say, it's another 10 handles south, right? But if so, then we have ourselves a meaningful sell signal into the upper 120s, 127.75, then anticipated within 3 to 5 weeks, couple of months at the most. So it's a bit stair-step right now. But the takeaway should be that 154.37 is our significant ceiling through the year, can contain annual buying pressures. We have tested it in late March, and below which, expecting at least 139.55, which we are testing presently in the May contract, and should over the next few weeks in the August contract as well when it inherits this level. And we could continue all the way south into the upper 120s, as I showed you a moment ago, as we move into summer trade. Just know that. Now, if we close above 154.37, which is a possibility, by the way, I mean, after all, I know this gets confusing, but stick with me. When August inherits this chart, it will be in the, just call it the low 150s. It won't take much to muster a rally to clear and settle above 154.37. And if that happens in the August contract at the end of this week, then we have ourselves a long-term buy signal in the broader feeder cattle market. And I would then anticipate what is right now around the mid 170s as a rising channel top. This would become a 3 to 5 month target. If we closed above 154.37, expect 175 even or this rising channel top within about 3 to 5 months. And over the next year or two, there's no reason to discount the possibility of the 220s, as you can see here. But that's not what's happening right now. Right now, the broader feeder cattle market has honored this ceiling, and below which 139.55 in reach over the next, I'm talking August right now, over the next 3 to 5 weeks, once it rolls into this chart, and perhaps the upper 120s as we continue into summer trade. And that's all I'm going to say about feeder cattle. Finally, wheat market. This is just a reminder. The broader wheat market remains bullish above 603.5. This is a long-term speed line that held the lows in late March, and above which we do have this long-term rounding bottom that's about a decade long. This can gain acceleration to the upside as we come to the upper part of this. And I've been telling subscribers the 850s are not out of the question by the end of this year. Now we need some, to clear some upside hurdles for this 850s to become a reality. And let me show you what those are. Initially, it's 661 even. And by the way, this is July wheat, not May. If we close above 661 even at the end of this week, and this is a weekly chart, then we have 737.5. I'm going to give this 3 to 5 weeks. I think we'll get price acceleration if we close above 661 even, 737.5, then considered in reach by the end of May, perhaps. I'm going to say June at the latest, end of June at the latest, where I might add the broader wheat market can top out through summer activity. This is our significant stair step on the way up to 852. If we close above 737.5 at some point, you say this summer, then this 852 and 3/4 speed line becomes a realistic 2 to 3 month target. So right now I'm going to say holding above 603.5, you should expect really the 737.5 formation over the next few months. Because I think closing above 661 even is really likely over the next few weeks, possibly this week. 737.5 remains a 2 to 3 month target above that 603.5 speed line where we can top out through summer. And if we close above 737.5, then expect this 852 and 3/4 speed line within just a few months. Downside, if we close this week Friday below 603.5, and I think that's a long shot, I don't see that happening, but if we did, then we have ourselves a long-term sell signal. 543 even, then expected within probably 3 to 5 weeks, and over the next 3 to 5 months, 483.5 anticipated in the broader wheat market if we close below 603.5 at the end of this week, but I don't see that happening right now. Bottom line, we are bullish above 603.5 in the broader wheat market. The next full year likely to reach the 850s, and if we can close above 737.5 in the coming months, then we actually may reach this 852 and 3/4 area by the end of summer, end of autumn. That is all I have to say for this week's AgriTalk video supplement.
So do yourself a favor. Fill out the free trial form on this website. Take that 2-week test drive. You have nothing to lose and much to gain.